Ever wonder how some investors seem to always make the right moves? Billionaires like Warren Buffett, Bill Ackman, Michael Burry, Howard Marks, and Monish Pabrai somehow buy the perfect stocks at the perfect time. It almost feels like they're playing a different game. Well, they are. The rich aren't guessing. They have data, strategies, and access to information that gives them an unfair advantage. But here's the thing. We can cheat the system too. Every quarter, these elite investors are required to share their trades through 13F filings, giving us a peek into their strategy. And right now, the smart money is making some bold, high-conviction moves. The question is, why? In this video, I am breaking down 5 stocks that billionaires are piling into right now, and more importantly, why these picks. And should you be adding it to your portfolio? Let's start with the first pick, a stock that Warren Buffett has been aggressively adding to his portfolio. Occidental Petroleum, OXY. Berkshire Hathaway now owns over 28% of the company, and Buffett has consistently been adding to this position quarter after quarter. This is one of the most strategic investments Buffett has made in recent years. Occidental Petroleum is an energy giant focusing on oil and gas exploration, development, and production. The company operates across the United States, the Middle East, Africa, and Latin America, making it one of the most globally diverse players in the energy sector. Buffett has always been a believer in energy as a hedge against inflation, and in today's economic environment, that belief seems stronger than ever. Looking at the numbers, Occidental has a market capitalization of $47.3 billion, making it one of the larger independent energy companies. Over the last year, it generated $26.7 billion in revenue, but what really stands out is its profitability. The company posted $12.6 billion in EBITDA, which is earnings before interest, taxes, depreciation, and amortization. That means nearly half of every dollar in revenue turns into pure operating profit before additional expenses. Its net income came in at $2.38 billion, showing that despite oil price volatility, Occidental remains solidly profitable. But what Buffett likely finds most attractive is its cash flow. The company generated $4.4 billion in free cash flow in the last 12 months, meaning it has plenty of cash left after capital expenditures to reinvest in the business, pay down debt, or return money to shareholders. Debt reduction has been a massive focus for Occidental since its high-profile acquisition of Anadarko Petroleum in 2019. That deal left the company with a mountain of debt, exceeding $30 billion at one point. But over the last few years, Occidental has aggressively paid that down, reducing its net debt to just $1.51 billion. From a valuation perspective, Occidental is not expensive compared to its earnings. The company trades at a forward price-to-earnings ratio of 13.9, which means investors are paying about $14 for every $1 of expected future earnings. Its EV to EBITDA ratio sits at 6.4, meaning its total enterprise value, market cap plus debt, is just over 6 times its annual operating profits. Compared to other major oil companies, these are reasonable valuations, suggesting that Occidental is still attractively priced. But why does Buffett keep buying more? One theory is that he's aiming for a full takeover of the company. Berkshire Hathaway already has regulatory approval to buy up to 50% of Occidental, which is unusual for Buffett, as he typically prefers to own significant stakes in companies rather than outright acquisitions. But the fact that he keeps aggressively adding shares suggests he's thinking bigger. Another key factor is dividends and share buybacks. Occidental has a dividend yield of 1.9%, meaning shareholders get nearly $2 in dividends for every $100 invested. While that's lower than some energy peers, the company has been aggressively buying back shares, which increases the value of remaining shares over time. In the broader energy market, oil prices have remained volatile, with global supply and demand constantly shifting. However, Buffett has always played the long game. Unlike traders trying to time oil price fluctuations, he invests in companies that can generate strong cash flows over decades, regardless of short-term swings. That's exactly what he sees in Occidental, a high-quality cash-generating business with improving financials and a dominant market position. Buffett is making moves in energy, but Bill Ackman is playing a completely different game. His latest big bet is on a financial giant that controls assets across real estate, renewables, and private equity. Brookfield Corporation. Let's break down why Ackman is betting big on it. Bill Ackman invests in companies that generate steady, compounding wealth over decades. That's exactly why he's been aggressively adding to his position in Brookfield Corporation, a company that most retail investors overlook, but one that plays a massive role in global finance. Brookfield Corporation is one of the largest alternative asset managers in the world, overseeing over $900 billion in assets across real estate, infrastructure, renewable energy, and private equity. While most investors focus on traditional stocks and bonds, Brookfield thrives by owning and operating real hard assets, things like toll roads, skyscrapers, power plants, data centers, and even entire city districts. In today's economy, assets like these are extremely valuable. Many of Brookfield's contracts include inflation-protected pricing, meaning the company can raise fees on its infrastructure assets when inflation goes up. This makes it a powerful hedge in uncertain markets. Looking at the numbers, Brookfield generated $97.99 billion in revenue over the last year, an increase from $92.77 billion the year before. But what really makes this company stand out is its ability to convert revenue into massive operating profits. Brookfield's EBITDA came in at $30.69 billion, which means that nearly a third of every dollar it earns turns into cash flow that the company can reinvest. Its net income, however, dropped significantly from $5.2 billion in the previous year to just $1.13 billion. The reason? Brookfield has been making huge investments into expanding its asset base, and these large capital outlays temporarily reduce reported earnings. But that's exactly how an alternative asset giant like Brookfield operates. It reinvests aggressively to keep growing. One area of concern is Brookfield's high debt load. The company has $233.7 billion in total debt, and while that number seems extreme, it's important to understand that Brookfield uses debt strategically to finance infrastructure projects that generate stable cash flows. It's not the same as a tech company carrying billions in debt with no clear path to profitability. Brookfield's assets are tied to long-term revenue streams, many of which have government-backed contracts. From a valuation perspective, Brookfield trades at an enterprise value to EBITDA ratio of 20.2, which means investors are paying about 20 times its annual operating profits. That might sound expensive, but considering Brookfield's scale, pricing power, and diversified asset portfolio, it's justified. So why is Ackman going big on this stock? Simple. Brookfield is a wealth-building machine that benefits from rising inflation, global infrastructure spending, and the long-term shift toward alternative assets. But while Ackman is focused on building wealth through assets and brands, Michael Burry is taking a completely different approach. Instead of looking for high-growth opportunities, he's focusing on stocks that are recession-proof. That brings us to his latest bet, HCA Healthcare. Michael Burry is known for making bold, contrarian bets, but when it comes to HCA Healthcare, his strategy is surprisingly conservative. Instead of looking for the next big market crash or high-risk short positions, Burry is doubling down on stability. HCA Healthcare is the largest for-profit hospital chain in the United States, operating over 180 hospitals and 2,400 care facilities. Unlike cyclical businesses that depend on consumer spending, hospitals generate revenue regardless of economic conditions. Whether the market is booming or in a recession, people still need medical care. The numbers show why HCA is such a strong defensive play. In the last year, the company generated $70.6 billion in revenue, up from $64.9 billion the previous year. This steady growth proves that healthcare demand doesn't slow down even when other sectors struggle. HCA's EBITDA came in at $13.86 billion, meaning that nearly 20% of every dollar earned turns into pure operating profit. But what really makes HCA stand out is its net income of $5.76 billion, which shows that even after accounting for expenses, the company remains highly profitable. One of the biggest concerns with HCA is its high debt load. The company carries $45.2 billion in total debt, which is significantly higher than its industry peers. However, this isn't as risky as it seems. Because hospitals operate with predictable, recurring revenue, HCA has the ability to service its debt without major financial stress. The company also generates strong free cash flow, which came in at $5.64 billion last year. giving it room to continue paying down debt while expanding its operations. From a valuation perspective, HCA trades at a price-to-earnings ratio of 14.4, meaning investors are paying about $14 for every dollar of profit the company generates. This is reasonable for a business with strong earnings and stable growth. Its EV to EBITDA ratio of 9.0 also suggests that while not the cheapest stock, it is priced fairly for its long-term profitability. Burry's decision to buy HCA suggests he is playing defense. Instead of chasing speculative opportunities, he is positioning for a potential downturn by investing in essential services. While Burry's approach is defensive, Howard Marks is taking a completely different approach. Instead of focusing on healthcare or consumer goods, Marks is betting on a turnaround in the telecommunications sector. That brings us to his latest big investment, Liberty Global LBTYA. Howard Marks has built his career on finding value where others see trouble. His firm, Oaktree Capital, specializes in distressed investing, meaning he looks for companies that are undervalued, misunderstood, or temporarily out of favor. That's exactly why his recent investment in Liberty Global is so interesting. Liberty Global is a massive telecommunications company that operates broadband, mobile, and television networks across Europe and Latin America. The company owns major telecom brands in the UK, Germany, Switzerland, and other regions, providing internet, cable TV, and wireless services to millions of customers. Over the last few years, telecom stocks have been struggling. Rising competition, high debt loads, and concerns about slowing growth have pushed valuations down. But Mark sees something that the market is ignoring. Liberty Global is still generating huge amounts of cash, and it's trading at an extremely low valuation. The company brought in $4.34 billion in revenue last year, but what really stands out is its profitability. Liberty Global has an EBITDA margin of nearly 79%. Meaning that for every dollar it earns, it keeps nearly 80 cents in operating profits. This is one of the highest margins in the telecom industry. The problem? Revenue has been declining, down at an annualized rate of 17.1% over the last 5 years. That's a major concern, but it also explains why the stock is trading at such a deep discount. From a valuation standpoint, Liberty Global is one of the cheapest stocks in the entire sector. Its price-to-earnings ratio is just 2.4, meaning investors are only paying $2.40 for every dollar of earnings the company generates. Its price-to-book ratio sits at 0.3, which suggests the company is trading far below the value of its assets. In simple terms, Marks is betting that the market is overreacting. While Liberty Global's revenue has been declining, the company still owns billions of dollars in telecom infrastructure, and it remains a dominant player in key European markets. If it can stabilize its revenue, the stock could be massively undervalued. One reason Marks might be optimistic is that telecom companies are highly resistant to recessions. People don't cancel their internet or cell phone plans, even when money gets tight. That means Liberty Global's cash flow remains strong even during economic downturns. Marks is known for buying assets when nobody else wants them and then waiting for the market to catch up. Liberty Global fits that mold perfectly. It's a cash-generating business that has fallen out of favor, but still owns valuable assets. So far, we've seen Buffett betting on energy, Ackman buying real assets, Burry playing defense, and Marks buying undervalued telecom. But the most interesting move comes from Mohnish Pabrai, who is doubling down on an industry that many investors have written off: coal. His latest big bet is on Warrior Met Coal HCC. Mohnish Pabrai looks for highly profitable businesses that are deeply undervalued, even if the rest of the market is ignoring them. That's exactly why he's making a bold bet on Warrior Met Coal, a company that produces and exports metallurgical coal, a critical material for steel production. Coal might not be the most popular industry, especially with the push toward renewable energy, but metallurgical coal is different. Unlike thermal coal, which is burned to generate electricity, metallurgical coal is essential for making steel. There is currently no scalable alternative to replace it, meaning demand for met coal remains strong, even as the world transitions to cleaner energy sources. The financials show why Pabrai is interested. Warrior Met Coal generated $1.53 billion in revenue last year, with an EBITDA of $441 million, giving it an operating margin of 28.8%. That means nearly 30% of every dollar in revenue turns into operating profit, an extremely strong margin for a commodity-based business. Its net income came in at $250 million, and even though free cash flow was slightly negative at negative $89 million, this was due to short-term capital expenditures that should pay off over time. What really makes Warrior Met Coal stand out is its low debt. Unlike other coal companies that have massive liabilities, Warrior Met carries just $173 million in total debt, giving it a debt-to-equity ratio of just 0.1. Another impressive metric is return on invested capital, ROIC, which stands at 32.8%. This means that for every dollar the company invests back into its operations, it generates nearly 33 cents in pure profit. This level of efficiency is something that most businesses, especially in the commodity sector, can't match. From a valuation standpoint, Warrior Met Coal trades at a price-to-earnings ratio of 9.6. which means investors are paying less than $10 for every dollar of earnings the company generates. Its enterprise value to EBITDA ratio sits at 4.75, meaning the stock is priced at less than 5 times its annual operating profits. These numbers suggest that Warrior Met is significantly undervalued, given its profitability and cash flow generation. While coal stocks have fallen out of favor due to environmental concerns, Pabrai is taking a pragmatic approach. Metallurgical coal is still a necessity, and Warrior Met is one of the most efficient producers in the industry.